We will be talking today about preparing for the Reconciliation Act, an estate and gift tax update, as you know from the title. And just so you know, just so you have an idea of where we're headed today, we'll be overviewing the pending legislation, and there is some other legislation besides the Reconciliation Act. But we will talk about the Reconciliation Act. We'll talk about some possible additions to the text that's been circulated a few weeks ago. Then we'll talk about some techniques that provide flexibility so that if you do something and then the law doesn't change, then maybe you can sort of undo the planning that you did. And we'll also talk about some other techniques that are very helpful, whether or not the law changes. But I want to point out, and we will do this later, that some of those techniques may be limited by the new law. And then we'll have time for questions at the end if they don't get asked along the way. So just out today was some news relating to the 2021 draft of the Reconciliation Act. First off, the price tag looks like it will be reduced from 3.5 trillion to somewhere in a range of 1.75 to 1.9 trillion. And that works out to about what the pay-fors were for the tax increases. So I don't expect the tax increase provisions to change. Just the scope of the bill is going to be narrowed. Some of the social programs that apparently are going to continue are the universal pre-K without an income limit, investments in green energy, and expanded Medicare benefits, which I think would include dental, vision, and hearing. Although the scope of it will probably be cut or limited. In addition, there'll be reductions in the affordable public housing that have been in the prior bill. The child tax credit probably will be reduced from 4 years to 1 year, and the paid parental leave will either be cut or reduced. And so maybe if there's an outline on the reconciliation bill by next week, sort of insiders say maybe the House would vote on the infrastructure bill, and then later this year vote on the actual reconciliation bill. As you know, there are different sides in Congress that are in disagreement about which bill should be voted first or if they should be voted together. So I wouldn't hold your breath. So right now I'm going to speak about the September 21 draft of the reconciliation bill. And the draft I'm talking about is the one that was voted out of the Ways and Means Committee on September 13, 2021. It's also known as HR 5376 or by the name Build Back Better Act. The effective date is January 1, 2022, but you have to be aware of that date because the date the committee voted the draft out of committee, September 13th, is also an important date for, at least for purposes of the new capital gains rate, and the date of enactment. A lot of the provisions apply on the date of enactment. So we have to be, we can't just be complacent and say, well, you have 2.5 months to do something. You may have a week to do something, but likely you have at least a few weeks left on the date of enactment provisions. The focus of the bill is to create recognition events and on raising income taxes on higher earners. It also reduces gift, estate, and GST tax exclusion, eliminates valuation discounts for non-business assets, and one that surprised a lot of people, it taxes grantor trusts as assets that are subject to the estate and gift taxes. And then I would note, today I'm not going to talk about all of the individual income tax provisions and the corporate tax provisions. There's a lot of them. There's also some provisions regarding IRAs, which won't be covered other than just with a few comments today. And then also many of the items that are in the bill currently, and the bill we're talking about is the 2021 draft of the reconciliation bill. They were part of Senator Bernie Sanders for the 99.5% bill. And so they have been vetted for cost and revenue. So it's known what the tax costs of those various items are going to be. Let's just go a little deeper into this 21 draft of the Reconciliation Act. These are 4 areas I want to focus on today. First, reducing the gift, estate, and GST tax exclusion to $5 million indexed. The elimination of the valuation discounts for non-business assets. Taxing grantor trusts as assets that are subject to estate and gift taxes. And by the way, that restricts the use of grats, idjits, cuperts, clats, and islets, and we'll wade through all those initials and what they stand for a little later. And then the bill also increases taxes on trusts and estates. So let's talk a little bit about the reduction in the estate tax exclusion. You may be aware every individual has an $11.7 million gift and estate tax exclusion, and with that also an $11.7 million generation skipping transfer tax exclusion. The September 21 reconciliation bill reduces the gift and estate tax exclusion and the GST transfer tax exclusion to $5 million indexed for inflation. So on January 1, 2022, the exclusion will drop to about $6 million, just over $6 million. So about half of what it is today. Now, under the existing law, that gift and estate tax exclusion and GST exclusion were scheduled to drop by half in 2026. So this is not news to anyone, it's just happening much faster. And because it raises revenue pretty simply, it's very likely to be in any final bill. And then, as I mentioned, it applies to gifts that are made on or after January 1, 2022, and it applies to decedents who die on or after January 1, 2022. We'll talk a little bit now about the limitations on valuation discounts. The discounts are still available for the transfer of a trade or a business. So an active trade or business, the valuation discounts are still available. But for non-business assets, and this is the new concept added by the Reconciliation Act, for non-business assets, those lack of marketability, lack of control, minority interest, those similar type discounts that have been permitted in the past when you were determining the amount of a transfer, either by gift or at death, are now no longer available. And so, for example, if you have a family limited partnership and it's funded with publicly traded stocks, that's not an active trade or business. And so you're not going to be able to get the discounts going in. Now, that doesn't mean that it might not still make sense to do these kind of techniques, because you can still get future appreciation out. It's just that we were also using the discounts to leverage the gift into the trust or into the family limited partnership, and therefore use up less exclusion. So it's still possible to use these techniques, but the leveraging in using discounts won't be available for non-business assets. Now, the one that's got a lot of people stirred up, and understandably so, is the changes to the grantor trust rules. 2 new code sections were added that basically try to reduce sort of the benefits of how we've used grantor trust rules in the past. I mean, the grantor trust rules originally were designed to sort of trap donors and grantors into paying income tax on assets that were put into trusts. And that planning was back when the top rates were in the 70–90% range. And so it made sense for people to try to find other ways to push income out to other irrevocable entities. The grantor trust rules basically put a stop to that, pulled all of that income back to the grantor. But for estate and gift tax purposes, these trusts were oftentimes irrevocable. There was a gift at the time of formation. The trust is not going to be included in the grantor's estate. You know, that was sort of how we sort of turned the grantor trust rules on their head and used them to the advantage for estate planning. Then the next step from there was to say, well, okay, because the grantor for income tax purposes is deemed to be the trust, and the trust is really just you know, for tax purposes one and the same as the grantor, we can do transactions with the trust that don't have any income tax effect. So we can sell assets to the trust and not incur capital gains tax, even though at the later death of the grantor, the assets will pass on to beneficiaries without being in the grantor's estate. So those, that's what these changes are trying to capture. They're trying to capture assets that are getting outside of the estate tax rules and they're also trying to capture capital gains along the way sooner than later when the beneficiaries of the grantor sell the assets. So there's a list here of some of the changes that were made. Oh, and I guess I should add, distributions to others from a grantor trust during grant. Well, let me back up. The effective date for these changes is the date of enactment for a trust that's created after the date of enactment. So a new grantor trust created after the date of enactment is completely subject to these rule changes. In addition, transactions that are made with a grandfather trust after the date of enactment also are subject to the new rules. So, for example, if you have got a grantor trust now, but you know in late December that you need to do a transaction, sell an asset through a defective grantor trust, or do other planning, because the event occurred after the date of enactment, and I'm assuming that this is something you've done, a transaction after the date of enactment, even a grandfather trust as to that portion of assets that are part of that transaction are subject to these grantor trust rules. And so as a result, it's going to make sense to pre-fund obligations now, possibly turn off grantor trust status now, again, before the date of enactment. And if you have a cash poor grantor trust and a cash rich grantor trust, you might merge them so that the two trusts together can continue to carry out whatever the plans were for those trusts without need for the grantor to add more assets after the date of enactment. Because if you add assets after the date of enactment, the understanding is that proportion of the trust is now subject to these new rules. So you're basically not wanting to do anything that causes the grantor trust to come into these rules if it's grandfathered. So basically the changes that were made is it makes distributions to others. If you make distributions to others from the trust during the grantor's lifetime, that's treated as a gift by the grantor. And so it's subject to a gift tax at that time. If the grantor trust loses its grantor trust status during grantor's lifetime, the assets are treated as if they were gifted to the beneficiaries of the trust, again, creating an estate tax event when you've already had an estate tax event when you funded the trust. At the time of death, the assets in a grantor trust are included in the grantor's estate, even if the assets otherwise would not be includable. So that's something to keep in mind is, we set up these grantor trusts oftentimes so they're not includable in the estate. And these two new code sections basically say we're going to include it in the estate anyway. And so now there is a provision that basically gives you back your exclusion if you've already been taxed on it once before. At least that's expected to be included in regulations. And then the other thing that these new rules make clear is that there's no step up in basis allowed for transfers to the grantor trust. And then any gift or estate tax liability is a liability of the trust, not necessarily the grantor or other people. The other thing I would say about the grantor trust rules is that most people who've sort of looked at them in any depth say that the way they're structured, it's a very clumsy way to tax grantor trusts, and there are probably better ways to do it. The other thing is the grantor trust rules were drafted very, very broadly to catch people and cause them to have to pay income tax. And so as a result, there's some ambiguity in the way that works. And there is some difficulty in making sure that you are or not a grantor trust. So we'll have to see. There'll probably be a lot of regulations on that issue as we go forward. So the next thing I want to talk about is the increased taxes on trusts and estates. The top bracket, well, let me start with, for income tax purposes, the top bracket has been raised from 37 to 39.6%. That's for trusts and estates. So it's the same as the change for individuals. And that increase, that 39.6% bracket, kicks in at $12,500 of taxable income. So it's a very, you reach the top bracket in a trust or estate very quickly. In addition, there is a new surcharge 3% tax on annual modified adjusted gross income for a trust or estate, where that income for that year, that MAGI for the year, exceeds $100,000. So by comparison, this surcharge applies to a married couple filing jointly only when their MAGI exceeds $5 million. So again, trusts hit the surcharge very quickly if it has more income over that's modified adjusted income over $100,000. There are scenarios where trusts and estates can be subject to the expanded 3.8% tax on net investment income. So you have to be aware of that. The 3.8% tax, what it applies to under the reconciliation bill has been expanded. And so trusts and estates can also be caught up in that expansion. And then finally, the Section 199A deduction for qualified business income for trusts and estates is limited to $100,000. And just limited to $10,000. And so by comparison, the limit for a married couple filing jointly is $500,000. So just as with the income tax, with the 3% surcharge, trusts and estates are severely limited in the kind of deductions that they can take and that the income that they're subject to. So I want to talk about some possible additions that might be made to the Reconciliation Act. I mentioned at the beginning, there's a lot of negotiating going on. The bill's still being negotiated even as we talk. So one of them might be to replace the step-up basis rule for estate tax purposes with carryover basis. A lot of our estate tax planning, especially for people who are under their exclusion amount, is to take advantage of the fact that assets subject to estate tax, even if you pay no estate tax, get a step up in basis at death. And what that step up in basis does is it eliminates the capital gains in the hands of the decedent. And what some other bills are discussing is to change that and basically tax that step up in basis at, well, I'm sorry, not tax it then, but there are some other bills that would do that. But to basically say that when the beneficiary receives the asset, inherits the asset, the basis in the beneficiary's hands doesn't step up. So an example would be the $100,000 of Apple stock purchased for $10,000. When the decedent dies, if he's under his exclusion amount, that $10,000 basis gets raised to $100,000 and $90,000 of capital gains tax is wiped out. And so then if the beneficiary were to sell that asset right then, they would have no capital gains and they would just sell it for $100,000, put that in their pocket, no tax. By replacing the step-up basis rule with the carryover basis rule, the beneficiary would have the $10,000 carryover basis. So if the beneficiary sold the asset then for $100,000, the beneficiary would pay $90,000 in capital gains tax. Another addition that was in Bernie Sanders' original bill would be to impose generation skipping tax every 50 years, to impose restrictions on grats, to increase the estate tax rate, add surcharges on larger estates, and then some other miscellaneous items. And I'm not rushing. I'm going to go into these in more detail on the following slides. So for example, I had already mentioned this example with the step up in basis, replacing with carryover rule. It's probably not likely to happen because it's difficult to administer, but there are some proposals that discuss a Canadian style tax on unrealized appreciation at death. And it is certainly possible that that could be added if it's needed for revenue to make the bill pay for itself. So the second change that was in the Bernie Sanders bill was imposing generation skipping tax within 50 years. And basically, this change in the law says if a GST trust was created before the date of enactment, then it's grandfathered for 50 years. And so that would be quite a shock to, for example, a Florida person who created a dynasty trust, a GST trust or a dynasty trust, because in Florida, it's a 360-year period. And so in Florida, the way the trusts are designed, they would go for 360 years, and they wouldn't be subject to estate tax in anyone's estates until after the 360 years. Well, this rule changes that and says if you have a trust that's once it goes 50 years, you've got to pay GST tax. And then the same, if a trust is created after the date of enactment, it can only have a 50-year term. And that's notwithstanding Florida's 360-year rule. Some other states have 1,000 years. Some states have no limit at all. And so, so you have to have a term for 50 years, and then you start over again. So we don't have this trust going on forever, never being subject to estate tax. And then trusts that are created after the date of enactment, this is the strange provision, are immediately subject to GST tax if the term is longer than 50 years. So if you create a standard dynasty trust next year and the bill's been enacted, then there's a GST tax as soon as you set up the trust. So it's that would be pretty shocking, but that, just remember, that was in some bills that were proposed. The other thing is there were some suggestions to change the GRAT rules to require a minimum 10-year term, and that the minimum remainder at the end of the term had to be at least 25% of the value of the asset put in, or $500,000. Now, the trouble with these changes is it sort of gives you a one-size-fits-all approach. And because it's a 10-year minimum term, even if you have a grantor who might not be in the best health, they can't pick a shorter term. Obviously, with a shorter term, the gift is lower, but so there's an increased risk of not outliving the term, which of course brings the asset back into the estate, including all the appreciation, and then subjecting it to estate tax. And then the minimum gift also reduces the availability to people and the leverage that it would give. Because of the minimum gift, you need to have a certain amount of principal to start with. And then because you can only do 10-year terms, obviously people who are older and have less than 10-year life expectancies, they're not likely to do these sorts of planning. The other problem with the 10-year term, and as an example of how it reduces availability, if I have an older beneficiary who's concerned about not living 10 years, we'll do 5 GRATs. Actually, let me use my example. We'll do 4 GRATs, and we'll put 25% of what we were going to make as a gift into the 2-year GRAT, another 25% into a 4-year GRAT, another 25% into a 8-year GRAT, a 6-year GRAT, and then the final 25% into an 8-year GRAT. So that way, if the person, they might not have a 10-year life expectancy, but they might have an 8-year life expectancy, and are hoping that changes in medicine will cause it to be even longer. So they live the 2-year term, then that 25% of the gift is out of their estate, permanently out of their estate, and all the future appreciations out of their estate. They live 4 years, they get another 25%, 6 years, and so on and so on. So by having a minimum 10-year term, it's very hard to do ladder GRATs for older people or people who are not in as good a health as other people. Another change that's possible that could be added, especially if revenue is needed to pay for the bill, is Senator Sanders' bill increased the top estate tax rate from 40 to 45%. The current 2021 reconciliation bill does not increase the estate tax rate. It keeps it at 40%. It does reduce the exemption to $6 million, as we discussed, but it doesn't increase the rate of tax. And that 45% rate, you have to realize that rates it's a graduated set of brackets that start at 18% and go up to this 40%, or if in this example to 45%. That increase starts at $1 million of assets. So even someone who has say a $7 million estate and only $1 million of their estate subject to estate tax, they're going to be at the 45% bracket at $1 million. So the full next $5 million of assets are subject to that bracket, and that $1 million above the exclusion is going to pay $450,000 on that example without any other deductions. And then also just keep in mind, Bernie Sanders' bill included a surcharge estate tax rate of 50% if an estate was over 10 million, 55% if it was over 50 million, and then a 65% rate if it was over 1 billion. And his rationale for that was that the top 1% of the country, about 300,000 people, owned more than the bottom 92%, about 300 million people, and he was looking for a way to pull those assets back out of the estate. There's another act that has been introduced in both the House and the Senate called the STEP Act, and I'm presenting this mainly just so you're aware, or if you've heard of some of these other things and you're wondering why isn't that being talked about, well, it may be because it was in these other acts that are at the moment don't have traction. The reconciliation bill is probably the way this is going to happen, but just be aware that these other concepts are out there. And the STEP Act, and it's been introduced by the House, in the House and Senate, so it's both a senator and a representative have stood behind this. But basically, they're trying to tax transfers. They're trying to tax capital gains. And so they do that by ending the carryover basis for gifts. So when you make a gift, in my example earlier, I said 100,000 of Apple stock. When you make that gift, the donee has a carryover basis because it's a lifetime gift. So their basis is still $10,000. Well, this bill would instead say we're going to tax it. When you make the gift, since there's 90,000 of capital gain in that gift, we're going to tax it immediately. The other change is to end the step up in basis at death. Same way at death, capital gains will be taxed, and then the capital gains will be taxed. Still get transfers to spousal charity without recognizing capital gains, and that's typical now. And then the bill also adds some new rules about how distributions from a grantor trust will trigger the capital gains tax. If the trust is included in the estate of the donor or the grantor, it triggers the capital gains tax. And then if you try to turn off grantor trust status, it's a deemed taxable transfer. So again, the STEP Act is trying to pull those things in and create events where capital gains are taxed. It also taxes non-grantor trusts, so it works both ways. But here, the capital gains tax is triggered when the trust is funded. If you make a distribution and there's more appreciation, again, you trigger the capital gains tax. And then there's a deemed recognition, even if you have no triggering event, and the bills are different, but every 21 to 30 years. And then there's a retroactive deemed recognition. So if the trust has already been going for 21 or 30 years on the date of enactment, then there's a recognition immediately. Again, basically, the STEP Act is trying to capture capital gains and tax them along the way and not have them just be wiped out by the estate tax exclusion. And then Senator Bernie Sanders for the 99% Act. Again, these are provisions that are vetted for cost and revenue, so it'd be very easy to drop them in, much like the 10-year rule for IRAs was dropped in to the Secure Act. And I'm only going to talk about things that we haven't already discussed, but in his bill, he wanted to reduce the estate tax exclusion to 3.5 million and not index it for inflation. He wanted to reduce the gift tax exclusion, split it from the estate tax exclusion, and drop it to $1 million. And then he wanted to cap annual gifts into trust. In other words, gifts that you not make to an individual person, but gifts into trust, like an insurance trust or something else, to 30,000 total per year. Which for a life insurance policy that had a fairly large premium, that would be quite a crimp on getting things done. And then finally, President Joe Biden had made some proposals early in this process where he wanted to end the step up in basis on gains over 100,000, tax unrealized gains at death, and eliminate 1031 exchanges. So those provisions were not vetted. Be much harder to drop those into the bill. So I want to talk a little bit now about some techniques that would provide some flexibility in terms of being able to do something now and then maybe change it later, or fail to make an election, or somehow be able to reverse the transaction if it turns out no changes are made. And so these are not exclusive, and they'll also overlap with Section 5 that we're going to talk about in a second. But basically, we're going to talk about formula gifts, loans to family members, disclaimer planning, Q-tip election trust planning, and SLATs, or spousal lifetime access trusts, intentionally defective grantor trust, charitable remainder trusts, Section 1031 exchanges, and installment sales. So with formula gifts, the idea is that you make a gift now before enactment of a defined dollar amount or a fractional share of an asset, using values as finally determined for gift tax purposes. So this is the type of planning that you may have heard of, where you use a Wandry clause. And basically what you're saying is we're making a gift, and the amount of the gift is defined by a formula. and we're bound by the gift at the time we make the gift. So it's not incomplete. The gift's not incomplete. We just don't know the amount, but we will eventually know the amount. And it provides some protection, obviously, on audit, because it's based on the formula amount. So if, for example, you tie it to the amount of the gift tax exclusion on the day of the gift, and you're trying to make an $11.7 million gift, then if for some reason the exemption is only $6 million on the date of the gift, then you're okay, because the formula says we only gifted $6 million, or in this case, 5.7 million. Well, I know 6 million. You're right. It does require some special drafting. You want to make sure it's done right, and there's some different variations on the theme for what happens to the gift. If the amount of the gift is less than what you thought it was going to be, what happens to that excess? It's not based on settled law. It's very similar to a marital funding clause. So in that sense, it's not unusual or strange. And there have been several cases that have worked out when it's good to do and when it's not good to do. And the reason you do these formula gifts is because we're now, if the exclusion drops to $6 million, you're in a use it or lose it situation. And by that, I mean, you have an $11.7 million exemption today, exclusion today, and it's going to drop on January 1st to 6 million, basically. And that 5.7 million excess simply evaporates. And the only way to not have it evaporate is to use up all of your $11.7 million exclusion before the date of before January 1st, 2022. And the reason is because if you only give away $5 million, you will use up 5 million of your $11.7 million exclusion. So you'll still have 6.7 million left. On January 1st, the exclusion drops to 6 million, and your prior gift of 5 million is taken against that 6 million. So you only have 1 million of exemption left. The only way to get the full advantage of the extra 5.7 million is to give away 11.7 million, or at least some number between 6 million and 11.7 million. So if you couldn't make $11.7 million gift, but you could make an $8 million gift, you will still have saved 2 million of that excess 5.7 million. But you have to do, you have to do it before the date of enactment, and it has to be for more than what we think the exclusion is going to be in 2022. And so that's a reason why people get a little leery about making a gift 11.7 million if the exemption might only be 6 million. Another thing to do, and again, it's because interest rates are still currently pretty low, is to make loans to family members or to a non-grantor trust for the benefit. Now, I added non-grantor here, and part of the reason I added non-grantor is because, again, the way the grantor trust rules work now is very complicated. The provisions being added to the trust code they do it by indirection and by deeming, and so it's not that clear, how even the new rules are going to work. And so my suggestion is that you at least think about doing non-grantor trust right up front, and then you don't have to worry about all those rules come later. And the point of doing it alone is that because the interest rates are super, super low. I mean, even though interest rates are starting to creep up a little bit, the required interest rate for a 9-year promissory note is just under 1%. So it's very hard to beat that kind of interest. So there's not a big cost to the person you're lending to. You can also do these things where you basically do an installment sale, for example, involving an intentionally defective grantor trust, and maybe even include a self-canceling note. And again, in the installment sale, you sell an asset that you expect is going to appreciate dramatically in the future in return for a note. And the note obviously has to bear a certain amount of interest. Well, at these kind of interest rates, the load or the carry to make the transaction work is fairly low. So if you do this loan and the gift tax exclusion is lowered retroactively somehow, before you actually got the gift made, then you don't do anything. It's a loan and it just gets paid back over time. But if the law doesn't change and you have excess exclusion amount, then you could forgive the principal in the future on this note. Again, can't be a prearranged plan to forgive the note, but it does at least give you the option, a little different option. Another set of planning that you can do is to do trust with built-in disclaimer planning. So you could make a large gift to a non-grantor trust for the beneficiary. The trust has provisions that say if assets gets disclaimed, they revert to the grantor. And if the gift tax exclusion is lowered, then you report the gift and you use up the prior larger gift tax exclusion amount. If the law doesn't change and the beneficiary is cooperative and is willing to disclaim the gift, then the assets go back to the grantor and you just start from ground zero. Obviously, you can't have a prearranged plan to do that. And the other nice thing about this disclaimer planning is you have 9 months from the date of gift to make a decision to disclaim. So you would, say you made the gift on December 1st, you have until August 1st, 2022 to decide whether the disclaimer is going to be made. And if the disclaimer is not made, then you'd report the gift on your October 15, 2022 gift tax return. Again, assuming that you extended your gift tax return in April of 2022. Another set of planning that can be done is Q-tip trust planning. This is where you make a large gift into a trust for a spouse. The trust does not, by its own terms, qualify for the marital deduction. So it's deemed to be a gift. But the trust also has provisions that would qualify it for a Q-tip or a qualified terminal interest property if an election is made. And basically Q-tip means that all the income in the trust has to be payable to the spouse during the spouse's lifetime. It can be no other beneficiary of the trust during the spouse's lifetime. Principal can't be distributed except for health, education, maintenance, and support. And there can't be other people who have powers over the trust. So again, it sounds daunting, but it is our standard Q-tip marital trust. So if the gift tax exclusion is lowered, it goes to $6 million, then you can elect Q-tip treatment. And by electing Q-tip, it's not a taxable gift. Now it's just a marital deduction. If the law doesn't change and you do not elect Q-tip treatment, so no marital deduction, then you end up using up the prior large gift exclusion amount. And then the decision to make that Q-tip election can be as late as October 15th of the year following the gift. So it provides quite a bit of flexibility in that regard. Now, related to that, but not quite the same, is a spousal lifetime access trust. Here, a grantor makes an irrevocable gift to a trust for the benefit of the spouse. The access for the grantor is indirect because it's based on the fact that the grantor and the spouse live in the same house. And as you can imagine, there's a risk there. If there's a later divorce, or if the spouse who's the beneficiary predeceases the grantor, now the trust moves on to the remainder beneficiaries, typically the children of the grantor. And so that can cause some problems. There are some there's some ways you can draft around some of that by defining who the spouse is or making the spouse the beneficiary only if the spouse is married to the grantor. That does increase some complexity, but there are some ways to do that. Another way some people do is they say, well, fine, we'll just do trust for each other. So husband makes a trust for wife, wife makes a trust for gift for husband. The problem with that is that that implies, or at least raises the issue that maybe there's a reciprocal trust going on. And when there are reciprocal trusts, basically the grantors of each trust are swapped. So now you just made a trust for yourself, and that doesn't get you where you want to go. It basically takes away the whole purpose of setting up the slats. Now there are ways. It's kind of hard now because we only have a few weeks really to do anything. There are ways to get around the reciprocal trust doctrine, but there is a risk open there by trying to do dual trusts. So again, if the law changes and if you need to, you can elect Q-tip treatment. And I say need to because you can set up a slat sometimes where there's little gift, and so maybe you don't need to worry about whether there's a taxable gift. But if you are worried about it being a taxable gift, the slat being funded being a taxable gift, then you can elect Q-tip treatment. So there's no taxable gift due to the marital deduction, and the assets out of the estate without causing gift tax exclusion. or using gift tax exclusion. If the law doesn't change, don't elect Q-tip. Just as before, you end up using up the larger gift tax exclusion because the funding of the trust was a taxable gift. And then you can make this decision whether you're going to elect Q-tip as late as October 15th of the year following. So we have some time to figure out what we're going to do with that. Another technique would be an intentionally defective grantor trust. Now this is, we use these a lot of times when we've run out of exclusion. And so it's set up as a sale. You make a sale to the trust in exchange for a promissory note, again at very low interest rates, as I mentioned earlier. And basically what you're doing is just selling this asset that you think will appreciate in value down the road in exchange for a down payment on the note and a promissory note. And so it doesn't use the gift tax exclusion because it's a sale. And because it's a grantor trust, the sale isn't real for tax purposes. So even though you just sold the asset, you don't incur the capital gains tax because it's treated as if the grantor never sold the asset. So it doesn't use gift tax exclusion. Now I say that with the exception of the initial funding of the trust. This is generally advised that say you're doing a transaction that's $1 million transaction. Typically you want to make a down payment of 10%. And you also honestly would like to have a little extra cash in the trust beyond the down payment. You want to be able to show that the trust has independent economic standing, so that it can actually make this promissory note, and it's a legitimate promissory note that's not likely to be bankrupted on. So my preference is that maybe you put 10 to 15% in, maybe even 20%, and also or that you put other assets independent of what you're selling to the trust into the IDGIT. The other way to do it is to make sure the asset that's going in kicks off a lot of income, and so it can more than pay for the payments on the note. So if the law changes, you've got the asset out of the estate without using gift tax exclusion, because if the law changes, the exclusion will be lower. If the law doesn't change, then you could decide later to make a gift of the note or to use this extra exclusion that you didn't use for other planning. So the catch here is that you have to set up this trust and fund it before the date of enactment. So there's not a lot of time to get that done. So shared remainder trust, basically you're transferring assets to a trust. You retain an income from the assets. It could be for you or you and your spouse for a term or for your lifetime. Often is for the lifetime of the grantor and the grantor spouse. And the remainder passes to charity. So because the remainder passes to charity, there's no estate tax exclusion needed at the later death. So you've got a pretty good advantage there. If you set it up as an annuity, then that's helpful, especially for hard to value assets, because you only have to value it one time at the very beginning, and that sets the amount. However, because it's an annuity, the amount is set, it's fixed, and it's not a hedge for inflation. You can set up a charitable remainder trust as a uni trust. That provides a hedge against inflation because you value the assets every year. And as the assets hopefully increase in value, or because of inflation, they increase in value, your unit trust payment each year will also go up. It's also possible to not use any exclusion at all with the charitable remainder trust by zeroing out the gift. Another technique would be a 1031 exchange. And the reason you would do this is because you're deferring capital gains tax. So if you're in the top bracket, you don't want to pay the 25%, then you do a 1031 exchange, basically saying, look, I just sold this asset. I'm now going to replace it with another asset. And so then you defer the capital gains until somewhere down the road, you stop swapping it into 1031 exchanges and just sell it and pay the capital gains tax. And maybe that's somewhere down the road when you don't mind paying the tax, or maybe you're hoping down the road the capital gains tax rate will drop again. This doesn't work if you're trying to offset capital losses against capital gains. It doesn't work if you're trying to offset expiring net operating loss carry forwards. And if you're trying to get an increased basis, because with the 1031 exchange, you just take the basis you had and you carry it over to your new property. You just keep carrying it over. So you're not going to get a new basis that you can take depreciation against. And just briefly, for a 1031 exchange, you first have to have an initial sale or exchange. And it can be property that's not primarily held for sale. So you can't be a dealer, or can't be considered inventory in your hands. And it can be exchanged for a like-kind property, but understand that like-kind is pretty broad. In other words, real property for real property, but you could trade a Wendy's store that's got, that owns its real estate for a piece of land that's vacant, that's being held for investment. The other thing is you have to identify the replacement property within 45 days of the initial sale, but you can identify multiple properties, and you have to purchase one of those replacement properties within 180 days of the initial sale. So that's how 1031 works. The other thing to be at least cognizant of right now is that if you're subject to capital gains tax, to maybe set up your transaction as an installment sale, and that will defer the capital gains tax so that you pay it as each installment comes due. And then, that can be valuable with higher capital gains rates. Now, some of the reasons not to do it are doesn't work for capital losses. And while you're doing it, and as each installment is coming due, you do pay interest on the deferred tax liability. So that's a change. And then you can't be a dealer, as I said before. This can't be real estate you're holding as a dealer, basically your inventory. And you can't do you can't do an installment sale with a related person. And then obviously, because you're deferring, you're not going to be able to apply. It does not apply to depreciation recapture. So that part of the sale is ordinary income because it's depreciation recapture. You're not going to be able to defer that through the installments. So I want to switch over to a few other techniques. And some of these may be limited by the law changes. And so, for example, I've noted here, talked earlier about GRATs, CLATs, CUPERTs, IRA conversions, annual lifetime gifts. Just note that on the GRAT, the CLAT, and the CUPERT, that you have to create the trust and fund it before the date of enactment. Otherwise, because they're basically grantor trusts, they're not going to work under the new rules. And then for an IRA conversion to Roth IRA, there are now going to be income caps and other limits that apply after the date of enactment. So if you're thinking about doing it, you may want to do it now when income tax rates are lower and there aren't the same limitations you have. So with a GRAT, grantor retained annuity trust, you make an irrevocable transfer of assets that you think are going to appreciate in value, retain a term of years, and then the remainder is either goes to trust for children or outright to children. This technique doesn't work real well for dynasty planning or gifts to grandchildren because you cannot allocate GST exemption to the transfer until the term of years ends. And by then, the appreciation you're trying to get out of your estate, you'd have to use GST exemption to do it. So it's not an efficient way to make a dynasty gift. But it does, the purpose of the GRAT is that because you're retaining a term of years, you're reducing the total value of the gift, and you're using that estate tax exclusion for other uses. You do have to outlive the initial term, but you do get your exclusion back if the deal doesn't work and you die prematurely. The other thing is with GRAT, you only have to appraise the asset at the beginning. It doesn't have to be revalued each year. So again, if you have a hard to value asset, it's ideal to keep your appraisal costs down. So just to give an example, if you have an asset worth $750,000 and you take a 33% valuation discount, you're only making a gift of $10,000. But if you're a 60-year-old and you do a 10-year term with a 5% payout during the 10-year term, and assuming 4% growth, your $500,000 gift, which was originally a $750,000 asset, is $265,738. That's because you're only gifting the part at the very end. And then the payments you received in your 10-year term are about $250,000. And the remainder in the GRAT at year 10 is over $752,000. This because all this appreciation, future appreciation, is outside your estate. And you can optimize to reduce the size of the gift to 0 if you need to. And so, for example, on the same numbers, 10.7% payout results in a zero gift, and you still get over $200,000 out of your estate. Another concept is a charitable lead annuity trust, And this is different than the typical remainder trust because it's the charity gets the interest at the beginning. So they get the lead interest, and then the remainder passes on to family and trust. And so it's a different approach, and the new law will affect this. And make it basically not helpful. But you do, if you have assets that you think will appreciate in value, then you put this term of years up front with the charity. And then because it's to charity, you're not having to worry about it being a gift, so you're not using up your exclusion. If the law changes, the assets out of your estate, and you also get an income tax deduction up front. If the law doesn't change, the assets are out of the estate, with the possibility of using children's estate tax exclusions instead of your own. And then because it's an annuity trust, it's only appraised at the beginning. So again, if you have a hard to value asset, it's ideal for that. I'll just give a quick example using the same facts as before. $750,000 asset, 33% valuation discount, 4% growth, a clap for 10 years for charity with remainder to children. You get an immediate income tax deduction of $350,000. The remainder taxable gift is only $400,000. And you have basically $660,000 of assets are outside the estate. So another concept is a qualified personal residence trust, or QPERT. Again, a irrevocable transfer, but in this case, it's your personal residence, either your primary home or vacation home. It's to a trust, and you retain the benefit for a term of years. And the remainder typically passes to children or in trust for children. And as I mentioned before, because of the GST planning, typically you would just go to children, not to grandchildren. They reduce the total value of the gift, so you can use that exemption other ways, and you just need to outlive the term. And then the other beauty is the assets only appraised at the beginning, doesn't have to be revalued each year. And this can be a benefit or a detriment, but if you want to stay in the house, you can retain the right to stay in the house after the term ends. You just have to pay fair market rent. Now that's bad because you have to pay rent. It's good because it's reducing your estate without actually making a gift. And it's also good because you're not having to leave the house if you don't want to leave the house after the term. Another concept is an IRA conversion to a Roth IRA. Basically, you're paying income taxes now for your beneficiary when your income tax rates are lower. Now, the Roth IRA is not taxable later when you take distributions. So that's always helpful. And then when the beneficiaries inherit the IRA down the road, they're not having to pay income taxes. However, they still required by the Secure Act to take distributions over 10 years. They just won't owe any income tax on it. So what you're doing is paying this discounted income tax for your beneficiaries now, which reduces the size of your estate. So that'd be a reason to be doing that. And again, the client doesn't have to take RMDs on a Roth IRA, but the beneficiaries will still have to take that RMD within 10 years, basically. Basically, it's a 10 years. You either pay it in 10 annual installments or get it all out by the last day. And the last thing I wanted to mention was annual lifetime gifts. These can be outright or to a trust that has current withdrawal powers. And again, you want to make sure that you use your $15,000 per person as much as you can, because it doesn't use your exclusion. There's no gift tax return required, and it reduces your estate for estate tax purposes. So any futures, the fact that the exclusion is going down, well, all this money you're getting out of your estate. So if you have, for example, if you have 3 kids and you love all of their spouses, you could be gifting $90,000 per year out to them and not even file a gift tax return. And then in addition, if you make the payments directly to a healthcare provider or directly to an educational institution for tuition, it's limited to that, not room and board, then you can do unlimited amounts in excess of the $15,000. So there are still lots of techniques available, even with the new law change. So I would say in conclusion, to not be complacent. some kinds of changes are coming. And it's either this year or next year, early next year, before the 2022 elections. And for sure, the exclusion is going to drop by half in 2026. It may seem like Congress is divided, but deficit hawks want to raise revenue, and the Democrat Party at the moment wants to pay for programs. So it's a strange bedfellows, but it's a recipe for change. Now, the date of enactment means that some of the techniques might not be available later this year. So you can't be complacent. You have to act now. And no matter what, if you start making some steps at planning now, you'll be ready for 2026, which is going to happen without any action by Congress. It means that everyone should be doing some planning. So we have a few minutes for questions, if anyone has any questions.
I see one question here, Tom, and I'm not sure if you covered it. Is there a solution to avoid estate tax before the current law expires in 2026?
Well, I mean, there are actually a lot of different ways. Some of the techniques we've talked about could be set up now. There are also some of these techniques that we discussed could be done after enactment, but the ones that involve the grantor trust rules, we're not sure how that will work. And so, for example, so a lot of the things I talked about you can be using now before date of enactment, and even after enactment, some of them can still be used to get assets out of your estate. So that the goal is to get assets out of your estate before you die or when you die, to not have more than whatever exclusion you have left. The other option that wasn't discussed on this seminar is that anything you give to charity at your death is not subject to estate tax. So a lot of clients do charitable remainder trusts, put assets in there because they want the use of the asset while they're alive, knowing that at their death, whatever principal's left in that trust is not subject to estate tax. So there are some ways to get around the estate tax using either these other techniques or using charitable techniques.
I have a client that's probably worth $20 million, he and his wife. They got a vacation house up in North Carolina, probably worth $3 or $4 million. Would it be best to put that in some kind of trust for their three children and get it out of the estate now? And how do they keep, and they maintain some kind of lifetime usage of it?
Yeah, I mean, the $20 million client, when you talk to them and you say, well, you should make, each of you should make an $11.7 million gift, they look at you and say, well, yeah, technically we have a $23 million estate, but if we give everything away, we're kind of in trouble.
Right.
And so that's why I mentioned earlier, I try not to do an all or nothing approach. That
right.
Just because you can't give 11.7 million, maybe you could give some more. Now, I don't think in the example you gave, that's going to work. But for example, why not do a QPERT of that house in North Carolina? They'll get it out of their estate. Real estate up there is appreciating, so eventually it'll benefit the kids. And then they can, as I said, they can keep the right to stay in there as long as they want, but they have to live the term. So that makes sense.
The only other thing they can do is probably convert their IRA to a Roth. That's probably the only other thing they can really do. Yeah.
And they could do, if it's a long-term marriage and they're very comfortable, they could do.
Yeah, they're both in their 70s. Yeah.
Either do a lifetime QTIP trust or do a SLAT. That's the other option. And then of course, remember, you can do two QPERTs. So if they have a home here and they have a vacation place.
Yeah, they have a beautiful home on Tampa Bay.
They could do
their homestead. So
yeah, but they can do that with both of them. And even though it's their homestead, they'll still keep the Save Our Homes.
Okay.
The asset valuation won't jump up. Now it will at the end of the term. So that's the difference. If they live 20 more years and the term of the QPERT was only 10 years, at 10 years, they would jump out of the homestead system.
All right, fine. All right, I appreciate that, Tom. Thank you so much.
You're welcome.
Thank you.
All right, I don't have any other questions, Tom, so I think that's it for us.
Okay.
Thanks so much, Tom, and thank you, ladies and gentlemen, for attending. Goodbye.